Thank you for joining us today to talk about another emerging trend that we're addressing in our mini webinar series. This is going to be about a 30-minute presentation, and we're going to talk about the emerging trend of supply chain disruptions. The purpose of this series, this mini series, is to dive into detail on the financial impacts of some of these emerging trends that we're seeing. In this particular presentation, we're going to talk about supply chain impacts and ways that companies and lenders can evaluate risk for that company. You're going to be able to develop questions and discussion topics that you're going to be able to use with a company to evaluate supply chain issues and what those impacts might be, what the impact of supply chain issues might be on financial performance into the future. So first, let's talk about some of the things that we're seeing in the supply chain world right now. We're seeing increased costs. We're seeing labor issues, both availability of labor, quality of that labor, and the cost of that labor. And we're seeing extended delivery times. The Institute of Supply Management produces several monthly data points, and its manufacturing PMI for the month of August was 59.9%. That's the 15th consecutive month of economic expansion. They also do a services PMI, and that was at 61.7%, which is also the 15th consecutive month of economic expansion. The US manufacturing sector is continuing to grow. That's clear by the statistics that I just showed you. When you survey US supply chain leaders, and Global Trans Enterprises has surveyed them for the third time this year, 2021, that survey showed optimism related to supply chain performance, but those same people, they identified that 70% of them felt like there were going to be challenges, continued challenges with that final mile or home delivery option. And 9 out of 10 of the survey respondents reported the need to increase hiring. Additionally, those survey participants, they felt 47% of them said salaries and wages are going to need to increase before the end of the year. Over 30% were concerned about having enough resources to meet demand. And more than 30% were concerned about congestion in the supply chain having an impact on increasing increasing transportation costs, labor costs, and they also expressed concern about potential lockdowns. The Institute for Supply Management also tracks the average production materials lead time, which for August was 91 days. That's up 5 days from July's report, and that's the highest average production materials lead time since ISM began collecting the data in 1987. According to ISM and the survey respondents, 62.8% of the respondents reported paying higher prices in August. Now that's down from 73.8% reporting paying higher prices in July, but it's still more than half of the respondents are experiencing increased prices. So let's talk about where some of these prices are coming from, what the trends are, and why they are material to a company's performance today. We're going to talk about marine transport, we're going to talk about trucking, and we're going to talk about air cargo. So first, when it comes to marine transport, a company called Freightos publishes different container indices that show transportation costs over time. And I'm showing you the global container index here. So this is looking at worldwide transportation processes what is the cost change? So in January of 2020, you were looking at an average cost of $2,500 a container. In today's world, September 3rd of 2021, you were looking at 4 times that, $10,519 to transport that same container. If you look at year over year, 2020 was a pretty flat year, but you can see how much the cost of shipping has gone up in 2021. And you can see the 10,915 from the prior graph, but you can see it laid against what those same companies experienced last year at the same time. Now, the global index doesn't tell the whole story. For US businesses, we really need to look at data for the China, East Asia to North America West Coast route and the China, East Asia, North American East Coast route. So let's look at what's happening there. So first I'm going to look at China, East Asia to North American West Coast. And previously, a company would pay $5,000 a container to receive the goods. That is now $19,040. Again, almost 4 times the level that was paid as recently as January of this year. If you look at the East Coast Index, again, previously less than $5,000 a container, and now you're looking at almost $21,000 a container for that same product to get shipped to a company. Also, it's important to think about where the ports are and what's happening to the ports. So you measure the size of a port by the 20-foot equivalent units, TEUs, that pass through it. And China, the port of Ningbo, they closed for 2 weeks in late August, mid to late August, because they announced that 1 employee had been tested positive for COVID-19. Earlier in 2021, another port was closed for a month for that same type of issue. And the reason that's important right now is because some of the stress that these Chinese ports are feeling is because the Chinese government is hosting the Olympics in February of 2022. And they want to make sure that there aren't any issues with COVID-19. They don't want those Olympics to be canceled. So they're taking additional actions about closing down ports when they are identifying that there are, or reporting that there are positive tests. I think that anybody who is receiving goods from Asia, from any of these Chinese ports, really needs to anticipate that between now and the Olympics in February of 2022, they may very well have other disruptions. In addition to port closures, staffing levels at the ports have been challenging, and some of the ports are operating at less than full capacity because of either government mandates or an inability to hire enough people. The port of Long Beach in California regularly right now has 60 container ships at anchor waiting to come in to be unloaded. It's not just the cost to transport goods that is increasing. The actual container boxes have been in short supply, and the price of a standard 40-foot shipping container has more than doubled from $2,375 in 2015 to $5,795 in 2021. And that further underscores the cost and the mismatch of where the resources are compared to where they're needed. Moving past marine transportation to trucking, The CEO of US Express in an August interview said that his company has raised the pay of employees, truckers, 30 to 35% over the previous 12 months. And he expects to have to do additional increases of 25 to 35% in order to attract and keep employees through the rest of this year. One thing that was interesting that he identified was that there's always been a difficulty finding the long haul truckers, the truckers that are willing to be gone from their personal lives overnight. And that has really intensified after the impacts of COVID-19, because there is so much competition for labor that he is now finding himself, his company is competing with a lot of manufacturing companies for the same employees at the same pay rates. And that's why he is feeling this stress and pressure to increase his labor costs. And on the trucking side, labor costs are a big part of a trucking company's cost structure, and that's resulting in pass-through increased costs to other businesses. When it comes to trucking companies, in addition to dealing with labor costs, they're also dealing with increased fuel prices, increased demand, and reduced container volume. So there are a lot of situations that are putting stress on the management of trucking, either the management of trucking companies or the management of captive trucking operations for other businesses. And just like you can go to the Freightos website and sign up for regular updates on the costs for marine transport of goods, you can also go to different trucking websites and sign up for index reports. There's the CAS information system, and there's also the DAT Freight and Analytics website. And you can sign up for information that will give you a sense for where those costs are trending. When you look at the national van rates and you look at July year over year, you see a 33% increase in the cost to receive goods via truck. And those increases, they're for every category of trucking, but they do range from 10.1% for spot truck posts. That was the increase year over year for spot truck posts, to 60% for reefer load to truck transactions. So an individual business and how it needs to use the trucking sector of the economy, different businesses are going to feel different financial impacts. And it's not just marine shipment and trucking shipment, it's also air freight. And when it comes to air freight, we're looking at both weight and volume. So the price of shipping product via air is based on either volumetric weight, the dimensional weight, or the actual physical weight. And again, you can see steep increases. Now, the overall Baltic Exchange Air Freight Index does show that some routes have experienced leveling off or a decline in costs in 2021. But I would call your attention to the green line, which is Hong Kong to America. And you can see that those costs have really gone up significantly. They're nearly double the 2019 level. So when it comes to trying to deal with supply chain, I've given you some background so that you can understand the cost impact that is being felt along the process from goods being shipped to goods being received by the end consumer. These costs are these impacts are further intensified by labor shortages, overall inflation, and commodity price changes such as the cost of energy. So you combine all of those emerging trends and you lay on top of that cyber attacks that are tied to infrastructure that supports the supply chain. Think Colonial Pipeline, for example, and the impact on truckers being able to fill up their trucks. And you see that these trends are coming together to put additional stress on businesses. So how does a business respond? Let's look at a couple of categories of responses. And before I move on to that, I want to say that, one thing that we're hearing and seeing when we're talking to businesses is that they might have had a supply chain management department that was 10 strong and doing a great job, and there were no issues. And now with everything that's happening, from a sourcing of labor and a cost of containers and sourcing of containers and trucks, those 10 people are stretched incredibly thin. And they're not able to keep up with everything that they need to keep up with. So many businesses are finding that they need to put additional resources into supply chain management to ensure that the business is best able to react to the situation. Excuse me. So when it comes to supply chain concerns, businesses are going to need to continually evaluate weaknesses in their supply chain, and they're going to need to develop alternative strategies. And some of those alternative strategies could be alternative suppliers. It could be reshoring or nearshoring, could be different transportation options, staffing planning, warehouse sizing, and technology and CapEx investment to ensure data availability. Let's take a little bit closer look at each of these. When it comes to alternative suppliers, we're talking about offshore, onshore, or even new options, new approaches to what needs to come into a company. Those are complicated decisions, and they can't happen overnight. We're also dealing with availability of resources. Can you find enough trucks? Are there barges available? Are there containers available? Is there staffing at the port, at the warehouse, to enable the product to come in? So the supply chain folks at a business have a lot of balls in the air that they're juggling and a lot of things that they need to be evaluating. One other area that supply chain people need to evaluate and the companies need to evaluate is the possibility that there needs to be some additional CapEx spent or increased operating costs. For example, does the company need to invest in additional warehouse space? We're seeing a lot of additional warehouse space taken down in certain areas. Does that mean that additional warehouse equipment has to be purchased? And is there a technology investment that's tied to that? In addition to the technology investment tied to warehouse space and warehouse equipment, you need to think about the technology that really enhances your ability to know where products are at any point in time. In today's world, you need to know where all of the inputs are coming in from and where they're at. You need to know if they're at a port in China, if they're sitting on a ship at Long Beach, if they're on a barge in the Mississippi. You need to know that, if they're on a truck. And then you also need to know where they are in the warehouse, and you need to know where the product is on the path to the final consumer. So it's really important that the technology, the real-time technology, is there when you have supply chain stress like we're seeing now. One thing that all of this supply chain disruption means is that there's going to be an increased working capital need. It kind of seems like it goes without saying, but there's going to be higher levels of inventory. There's going to be stress on supplier lines of credit. And these changes in working capital management can impact the line of credit structure. In an ABL world, you might need to deal with increased line maximums, slower inventory turn standards. Maybe you were categorizing inventory as slow moving if you had more than a 6-month supply on hand. Now, maybe that has to happen. You have to have 6 months on hand. So maybe it's 9 months or 12 months that would make an inventory item slow moving. You also have to think about changes between asset classes. You can be dealing with additional raw materials inventory or additional finished goods inventory. And you might also be dealing with changing investments in inventory versus accounts receivable. And also, ineligible calculations need to be considered because some of the ABL structures that worked in 2019 and 2020 are not working well today. So what does this mean? How does a business respond, and how does a lender think about how the business is responding? So the best practices, that's going to be key. A business that implements best practices and uses that discipline to analyze performance is going to be in a better position to deal with the situation as it unfolds and to change as needed. So when I'm thinking about different types of analysis techniques, one that I focus on is sensitivity analysis. I want to know what a 10-cent per mile increase in trucking costs means to my bottom line. I want to know what a $100 increase in the cost of a shipping container transport means. I want to understand a $1 increase in the price of fuel. I want to understand a $1 increase in labor costs. And I want to also think about inflation and commodity price changes. So when I've done a sensitivity analysis, I can better understand and therefore better manage a company through this kind of difficulty because I understand immediately what a change in the cost structure means to the performance of the business. I also think another best practice is to be constantly evaluating different shipping and inventory management options, contract evaluation, make sure that there's a list of contracts, when they expire, what the automatic renewal terms are, what, if any, escalation costs there might be, or escalation terms there might be in that contract. And think about new suppliers and how you want to negotiate contracts with new suppliers and how you want to negotiate with new customers when you're dealing with the supply chain issues that you're dealing with right now. This is also a time when best practices on inventory management are critical. You need to know inventory turnover by SKU. You need to know and understand the contracts that you have and the opportunities you have to pass along costs. You need to make sure that your bid procedures are in line so that if raw materials are increasing, are you able to increase the eventual cost of the product? So inventory management and doing all the things that you need to do to manage, to better manage inventory right now, those best practices are key. And it's not just inventory, it's all the factors that relate to operating cycle management. So that means cash, accounts receivable, inventory, and accounts payable. You want to understand the credit and collection processes or policies, and are those processes continuing? What are the supplier lines? Has anybody been granted extended terms? What does the line of credit look like? If you roll forward accounts receivable and inventory and accounts payable, what happens to the line of credit structure and the line of credit needs? When we're thinking about accounts receivable in the supply chain, think about higher per unit revenues mean higher AR levels, and that can mean stress on the collection process because each business that's transacting business with another business, one person's AR is another person's AP. So the things that a business that you're looking at is dealing with on the AP side is the same as what someone else is dealing with on the AR side. So make sure you understand what's happening on the collection process and what the stresses are. On the inventory side, we're seeing a lot of need to have higher inventory levels, and that can be both dollars per unit and number of units. So we're seeing a higher investment in inventory. And on the accounts payable side, we're seeing stress on accounts payable. Oftentimes, businesses have had to shorten the payment terms that they're using with their vendors in order to ensure that the vendor delivers the product to them. So you want to be thinking about accounts receivable, inventory, and accounts payable operating cycle, and you need to really consider the line of credit, its overall size, the relationship between asset categories and ineligibles. A thorough understanding of this whole cash flow process is critical to making sure that the company understands its risk as related to the supply chain issues and other emerging trends. So how does a business deal with this kind of uncertainty? Because nobody has a crystal ball. So we see some businesses that just kind of, they feel like whatever's going to happen is going to happen and they're reactive. And we see other businesses that are proactive. They're using the best practices. They're instilling the discipline in analysis. And the companies that are going to survive 2021 and its emerging trends and be better positioned for 2022 are the people who do those analysis, who perform that analysis and use those best practices. But really important to consider when you're looking at a company and its management team. Successful businesses manage their risk, and supply chain issues are just one part of risk management issues that companies are feeling today. With the amount of uncertainty that companies are experiencing and the headwinds that are coming at them, each company needs a person, and you can call them a change agent, you can call them a disruptor, a risk manager. The name isn't important, but what is important is that there's somebody at the business who is a champion of analysis and driving change. Somebody who is willing to question the status quo, evaluate different options, and consider their impacts. So the businesses that I see that I think have a higher likelihood of success in the future are the ones that react through analysis and planning to these kinds of issues. So with that, I'm going to explain again about our FocusMG.com website and our Insights page. So if you've listened to these webinars in the past, you've heard some of this before, but if you go to FocusMG.com and you go to the Insights tab, which is on the top section of the homepage and towards the right, you'll see an Insights page. And in that category on our website, you'll find multiple articles on industries, best practices, working capital management, cash flow, emerging trends. So please use that part of our website as a source for information for you when you're trying to evaluate a company's performance. And I'm also going to show you all of our telephone numbers, our cell phone numbers, and our email addresses. And please feel free to call me, call anybody in this list. Go to the website and contact us through the website. We really enjoy hearing from you about what you're seeing and That helps us and helps you. If you want a deck of this presentation, just send an email to info@focusmg.com, info@focusmg.com, and Patrick will be happy to get a copy of this deck sent over to you. So thank you again for spending some time with us, and we hope that this helps as you're evaluating companies' performances into the future.